Okay, so we're going to talk about working capital management decisions. Firstly, we're going to look at the cash conversion cycle. So the cash conversion cycle is also known as the net operating cycle. This is the length of time to turn the firm's cash investment in inventory back into cash in the form of collections from the sales of that inventory. The cash conversion cycle is computed from the average receivables collection period, average inventory processing period, and the payables payment period. So basically, the average days of receivables, it is the average number it takes for our debtors to pay. And then the average days of inventory, it is the average number of days it takes for us to sell the stock that we have. And then the average days of payables, it is the average number of days it takes us to pay our creditors. Okay, so if we add the average days of receivables plus the average days of inventory, and then we subtract the average days of payable, we get the cash conversion cycle. So high cash conversion cycles are considered undesirable. A cash conversion cycle that is too high implies that too much of our capital is held up in working capital. And then we're going to move on and look at the available sources available for short-term debt financing. So firstly, we're going to look at overdrafts. An overdraft is a highly flexible source of short-term funds provided by a bank up to a set limit. It can be a useful method of providing for short-term cash requirements. Okay, so an overdraft is just a short-term funds that we get from the bank. It can be drawn at any time, and it is most useful for the day-to-day expenses. Okay, so when you get an overdraft, you might use it as a company to pay for your day-to-day expenses. However, it is relatively a very expensive way of borrowing for short-term. So the advantages of overdrafts is that it is flexible, and also it is quick to arrange. The disadvantage is that charges for exceeding overdraft limits without authorizations can be very high, and then the bank has the right to ask for repayment of overdrafts at any time, and it is only available at the company's own bank. So as a bank, you can only get an overdraft at the bank at which you are banking with. You cannot just get an overdraft from any other bank. And then we move on to short-term loans. Short-term loans provide a loan for a specific period of time and for a specific amount of money. So short-term loans are usually for a specific period, for example, 3 months, and then also the amount is also specific. The advantage is that the date of repayment is known, and you also get the amounts the promised amounts in full on the agreed time. The disadvantage is that you might require security, you might need collateral to get a short-term loan. And also there's lack of flexibility, and also let's say you borrow money that you no longer need, you still have to pay interest for the money that you borrowed. So factoring is whereby a company sells its accounts receivables to a third party called a factor. When used for funding purposes, advance factoring is undertaken when the factor provides financing to the seller it to the seller of the accounts in the form of a cash advance, often 70 to 85% of the invoice amount. The balance of the purchase price is paid net of the factor's discount, commission, and other charges upon collection. Alright, so what happens in the factoring is that a firm, it sells its accounts receivables to a third party, which is the factor, and then they get cash in advance for the invoices. And then when the balance of the purchase price is then paid, that's when the factor is now paid. That's when you pay the factor his commissions and also other charges. We have an example here. Accounts receivables 100,000. An agreement is made with the factor that 80%, that is 80,000, is paid now at a 5% fee. So what happens is that upon receipt of the debt, 5,000 is then kept by the factor, and the remaining 15,000 is paid over to the company. Okay. So the company gets 80,000 now, and when the debt is paid, the company will then pay the factor the 5%, which is 5,000, and then the remaining 50,000 is kept by the company. Okay. The other factors which concern factoring include, there are many factoring companies, so a company can negotiate with a number to find the best rates. So before you enter an agreement, you can negotiate with many factors to find the best rates which suits you. The company can protect from bad debts by taking the non-recourse factoring service, although the factor charges more for this due to the risk taken. Cash is released as soon as orders are invoiced, helping to fund future payments to suppliers. Factors will credit check customers, which can help reduce bad debt risks. Internal costs of managing sales and credit control can be reduced. On the downside, factoring can suggest cash flow problems to customers, and there is a loss of control over methods used to chase up debts. As such, it may worsen the company's reputation with the customers. Okay, so customers can know about the factoring, and it can suggest that the company has got cash flow problems, which can now worsen the relationship of the company and its customers. And then we move on to invoice discounting. It is also very similar to factoring. When a business enters into invoice discounting arrangement, the finance company allows the business to draw down a percentage of its outstanding sales invoices, usually in the region of 80%. As customers pay their invoices and new sales invoices are raised, the amount available to be advanced will change so that the maximum drawdown remains at 80% of the sales ledger. So the finance company will charge a monthly fee for the services and interest on the amount borrowed against the sales invoice. So basically, in invoice discounting, the company will be borrowing against its sales invoice. In addition, the finance company may refuse to lend against some invoices. For example, if it believes the customer is a credit risk, sales to overseas companies, sales with very long credit terms or very small value invoices. So the finance company basically chooses the invoices it is able to to accept. Okay, it is able to accept so that it can loan money to the company. So usually if they feel that their customers, it's a high credit risk, or the sales are to overseas companies, or the credit terms are too long, or the values are too small, it might refuse to lend against those invoices. or the difference between invoice discounting and factoring is that with factoring the debt is sold to the factor who processes the debt, while with invoice discounting the responsibility of raising sales invoices and for credit control stays with the business. Okay, so the customers will not know about this, unlike in factoring where the debt is actually sold. In invoice discounting, it's only borrowing against invoices. Also, the advantage of discounting over factoring is that it can be arranged confidentially so that the customers are unaware of the business borrowing against the sales invoice. So we have selective invoice discounting. This allows the company to select individual invoices to discount and so receive funding on an invoice by invoice basis. Okay, so basically here the company selects the invoices on which it wants to receive the funds, on which it wants to borrow against. So the advantages of selective invoice discounting include quick funding, its flexibility, and so forth. So we now have export factoring. Export factoring is essentially the same as factoring. The company can choose to invoice in one currency and be paid in another currency. This helps to manage foreign exchange risk, as if payment is made immediately, there is protection against currency fluctuations. Alright, so under export factoring, your invoice might be invoiced in one currency and you might choose to be paid in another currency. So usually, export factoring, the fee is usually slightly higher than domestic factoring because there's now increased risk of currency risk which is being faced by the factor. Okay, and then we'll finish off with an assignment. So part A of the assignment: what are the issues involved in setting corporate policy concerning current assets and current liabilities? And then section B of the assignment: briefly explain the differences between permanent financing needs and seasonal financing needs. So part A has 10 marks, part B has 10 marks.